morning, everyone. Welcome to this live session together with a few guests today. Very excited to have you here. So we have obviously Ryan Darnell, for those who have followed us before, and Vincent Deluard from StoneX Group. So nice to have you, Vincent. Very excited to get today. We're going to talk about macro, but before we go, maybe if you guys want to introduce yourself to the audience for those who don't know you.
Maybe I'll go. So hi, my name is Vincent Deluard. I'm in charge of global macro at StoneX. I've been doing that for almost 10 years. I used to cover Europe for Ned Davis Research before, and I guess the maybe some of you know me. It's probably for an early call on secular inflation and the fact that recessions are a thing of the past. They're canceled. That's it.
And hello again, Ryan Darnell. I've been in the industry 17 years as a market maker, derivatives trader, also financing and various other things. I tell people if it's a risk in the commodity supply chain or derivatives, I've probably managed it.
Nice. So basically, Vincent, just to give you a background, a lot of our traders or users are kind of like retail investors, retail traders, futures traders. But I think the macro environment, especially for the end of the year and looking forward to next year, is going to be very important. So I know we're getting close to Thanksgiving, which is normally a period where market kind of like dies down and volatility is kind of lower, but maybe this year is going to be a little bit different. So maybe share with us what are the things that you look for and what's your macro view for the end of the year and maybe going into 2026.
Well, so I'm gonna maybe start by sharing something that I missed. I thought so. I've been generally bullish stocks this year, but I thought we'd have a full correction, and I think I'm taking the L on that one, and I think I'm not the only one taking the loss. I think a lot of people, right? We saw certainly markets rally pretty hard after Liberation Day. Part of that was initially made sense. I think by the summer people were getting nervous, and we saw volatility spike October, but yeah, stock's not correct. So at some point you got to cut your losses. Now I look at as you mentioned, seasonality is usually pretty good. As you know, I'm kind of I think all these recession stories are overblown, and the surprise once more will be that Americans are going to do what they do best. They'll shop. Earnings are growing. The Fed is cutting rates. Monetary conditions are easy, and we have that nice round 7,000 number on the S&P 500. And I suspect a lot of people like me who were hoping to buy the dip in October, and there was no dip to buy. So that might lead to some kind of chase in the last month of the year.
So I think it's been a common theme when I've talked to other risk managers and options traders is everyone's worried about the tails. Everyone's worried about a crisis, and you see those on the news every day, right? Someone's calling for a crisis, or this looks like 1929, or this looks like 2007. So maybe two-part question to that. I mean, my first one is, do you see any of those parallels that people are warning about? And then the second one, the more nuanced question to me is, a lot of people are saying with valuations this high, it's going to be hard to have long-term forward returns that we've grown accustomed to. And but that doesn't necessarily mean we have to have a crash either. So how, do you think that whole long-term return story is wrong? You think the Goldmans of the world who are talking about kind of 1% real returns are just missing the boat? Or do you think that there's some sort of soft landing scenario? How do you kind of balance those tails versus these kind of expensive valuations?
Right. On the tail risks, I mean, they are there. They're always there. But I think they're receding. I mean, the tail risks were always, things that had to do with trade negotiations, and we certainly see a much more conciliatory approach from Trump. And the other tail, to me, the biggest tail really is long-term bond yields and the fiscal situation. And at some point I think we'll see long-term yields above 5%, and that I think that would be the kind of bond market vigilantes, if you will. And that would be a problem for valuations, when you have stocks like 25, 26 times earnings. But we're not there yet. I mean, that's the point, right? I mean, I can't really explain why, because I look at what's going on in Europe, in Japan. I see these kind of rising term premiums and higher yields. But in the US, we are, I mean, today is a bit up, but we're at 4%. So we still have time for the bull to run. In terms of the valuations question, listen, there are huge, I mean, there's certainly areas of the market that are massively overvalued. You get some, nuclear stocks with no revenues, multi-billion dollar. You look at, crypto treasury companies, the Ponzi's on top of Ponzi's. Obviously, there is now. It does. The fact that some things are overvalued doesn't mean that they're gonna pop right away. And I would, to some extent, I mean, I hate to sound, Irving Fisher had this famous quote in 1929 about a permanently higher plateau for stocks. So I'm gonna take inspiration from the greats here, and I'm gonna say maybe we are at a permanently higher plateau for valuations. And so my basic macro thesis for the past 5 years since COVID is that we kind of reset to a world of higher growth because we have permanent stimulus. And we certainly see that, right? I mean, that we have a deficit of 7% of GDP at the time of expansion. We have a Fed that cuts before it gets even this. Things might slow down in 15. I mean, it's insane, right? I mean, you have inflation at 3% and unemployment rate at 4%, and then they're cutting. So if you believe that, and I think we also have financial repression. I think that's one of the reasons why we see long-term yields so well behaved, is because you can't let them go up. So if all these things are true at the same time, stocks, that basically removes that tail of a recession. And if you think there's no recession, that means earnings are gonna grow anywhere between 6 and 10%. What's a reasonable P you pay for that when bond yields are at 4%? I mean, you can pay 25. So as a whole, I don't think the market is necessarily that overvalued.
Yeah, you bring up a great point too. I mean, it's always scary to say that this time things are different. It's easy to end up with egg on your face, but I do agree with the big thing that I've always been a long-term, buy stocks, and these are the reasons it's going to work, and these are the reasons the market's fairly efficient. I think one of the things that's really concerning is with these is financial advisors who have been kind of repeating that for decades have really been successful. And if you look at it, people are just passively buying market cap weighted funds, and they're not really changing that, right? Like I think recently, I think it was the Wall Street Journal put out some analysis during the spring and summer that retail investors who historically might have panicked and sold when we had a big sell-off didn't. They just kind of continued to passively slap money into their 401ks and IRAs. And so I do think there's some legitimate points that maybe people just don't see the need for as high of a risk premium on the stock market anymore, because they've kind of seen how it bounces and recovers. And the way that people are using it is just a piggy bank now, which is good. I mean, that's what we've been encouraging, right, for a long time in the finance industry. And so if that's been successful, how does that change things, right?
Yeah. So two thoughts on that. One is that, I believe there has been a structural change in the market. I mean, we are investing, the idea is you should put 10% of your income in your 401k every year with a match. That's 1% of GDP every month. And we're doing this in a completely passive, automated way, right? And you mentioned the buying the dip. I'm not sure. I mean, so there is some deep buying, like the BTFD, whatever. But I think that the biggest story, if you think about, like trillions of dollars, is this whale going into a Vanguard target date funds. And it, just by the structure, it buys the dip mechanically, right? Because if you have a target date fund and they say you're 40 something and you're 70-30 and stocks are down by 10%, or like they were in April, they're down 20. Your 70-30 now is 65-35, so you got to buy stocks, right? And you're not looking at valuations, you're not looking at the Fed, you're not looking at earnings, you're just looking, oh, that's my target, that's what I need to do. And we're talking indeed a massive flow, right? Again, 1% of GDP every month flowing into these vehicles. And it makes sense that I mean that's basically my buddy Mike Green. I'm sure you've heard of it, and it's easy. It's the more we move in that direction, the higher the valuations go. Now you can make a case that it's all going to end in tears, and the markets are going to dysfunction. But my point is we're not there yet, and I don't see a reason for it to break. Like next year is going to happen again. I mean, the only difference is this year we have $1 trillion in capital gains, and that. It's kind of this miracle of, and that's why I remain this kind of high growth camp, this miracle of inflationary growth. Like assets go up, people have money, they spend, consumption stronger than people expect, and then the tax receipts are stronger. Tax receipts are very strong, so the government can keep spending, and to me, the wheels are still spinning.
I mean, so one of the things you were saying about multiple things can be true at once, and kind of all these things, I think. One of the things that's remarkable to me that we were talking about last Thursday was, usually you would expect with the story you've just kind of told and everything being so good, you would think that alternative assets, and traditional hedges like gold would be really weak, right? And I know, again, there's a lot to talk about, but it's kind of like, okay, well, what's the protection? What's the tail risk? Because gold is telling us that, that we're in full on crisis mode. And I know there's some supply and demand factors, but I'd love to hear how you reconcile those things.
So generally, I've been a big believer in the gold story. Obviously, I have this view of, kind of secular inflation plus financial repression plus permanent stimulus. So very happy to see gold do what it's done. Also crypto. I also think in that kind of new environment that I was describing, where you have like structurally higher growth, the main risk is that the economy runs too hot. And when that's your main risk, bonds are not a good diversifier. So your 60-40 portfolio is kind of broken and you're looking for alternative. And I think that's been quite a lot of that bit for gold and crypto is, diversification is harder to get. And, gone are the days when you could get paid, 2% real yield to own something that would go up when the stock market goes down, which used to be long-term treasuries. So very happy about the way it played out. Probably I would say still long-term bullish on gold. But obviously we had kind of this blow off top. It was insane, right? I mean, we saw these like, $100 moves day out, day in. So I don't know. I mean, if you have an allocation to gold, I would absolutely keep it. If you don't have one, I think you absolutely should have one. Now, is it where you want to deploy capital? I would look at other parts of the commodity world. Generally, I think gold is always trying to tell you a message, and only time reveals what that message is going to be. If you look at how the gold price acts, it rose a lot before, it ran a lot before COVID. And then it corrected much before the Fed started to hike rates. So gold kind of had like this 6 to 12 month lead time. You see gold do something and you're like, why is gold selling off? The Fed is printing money and buying MBS and like that. I remember, in 2021, because gold was sniffing out the rate hikes. I think gold is sniffing out something for 2026. I worry that something is going to be higher energy prices, and I think from a equity standpoint, really what could what could unravel the thesis I was describing, this kind of perpetual motion machine that we seem to have created, right? With more money in 401k, we have higher prices linked to higher consumption. We can always sell an AI bubble. We have this circular financing. Like it works. Now, what could break it would be, I think, if we had a meaningful rise in inflation, which I believe is still not contained. You look at super core, it's at 4%. Now, what's helping inflation right now is the fact that commodity prices have been so weak. But if for whatever reason we had higher commodity prices, we wouldn't be. Right now, the Fed still has credible cover to say that it's ish, like that was what Powell was saying, ish. We're well, you take the PC 2.5 ish, whatever, right? Well, if you have like, an increase in energy prices, you cannot do that. So I would see, and again, that would be generally the pattern. Like typically in commodity prices move in waves, and I worry that kind of surge in gold prices is paving the way for higher commodity prices. And I think again, that's the main risk for 2026. I would still be long equities, even though I'm very nervous. But I think one way to hedge that is with a long position in energy stocks.
Oh, interesting. Yeah, because I think I completely agree with you. It's remarkable how the Fed has just quietly backed off of their inflation target and just kind of said, well, it's not that important. I mean, to your point, they kind of wishy-washy about it, and they're still leaning on the Volcker credibility and the kind of past credibility. And would someone argue that they're getting smarter and that they're being more forward-looking and trying to not be chasing from behind? But from my seat, it definitely looks like they're also just pretty happy to keep the good times going, right? And keep the bull running. So yeah, you bring up a lot of great points. I guess I do. So you brought up a really interesting point about how, gold and crypto can benefit as people are trying to change the 60-40 portfolio and taking money out of bonds to do that. And because that was going to be my kind of next question about gold. From my seat, I'm always kind of long-term value guy. And what I've looked at consistently is for gold, for crypto to go up, since they're not inherently assets in the sense that they're not producing more of something like farmland or gold mining. For them to grow, you really need to kind of make the case that capital flows are going to continue to move into them, right? And increase demand for those assets. And so, yeah, where do you think that's coming from? Do you think it's going to continue to come out of bonds? Do you think at some point it can shift from equities, or at some point do they just run out of, the next buyer, the next marginal buyer for those assets? I mean, my understanding for gold is that it's been more central banks being the marginal buyer right now with this kind of de-dollarization and people trying to, reduce their exposure to Trump. But yeah, I guess that's my question is, do you think we can continue to shift from, it sounds like you don't think it's happening from equities. I agree with you. I don't think it's coming out of equities. So then the question is, can it continue to come out of bonds?
So on the flow perspective, I think I have a better picture for gold than crypto. I'm a bit worried, to be honest, on the crypto side, because we had so much good, everything that could go on was so good, right? We had what's current 60 billion go into crypto ETFs. We had the treasury, Bitcoin treasury companies raise ungodly amounts of money and weak action. It's always something that, tells you that something's happening, right? There must be distribution. If you see a lot of new money flow into an asset and prices don't move. So, crypto, I'm not sure where that marginal buyer is coming from. For gold, I mean, the narrative is pretty, straightforward, and, people have made it on many podcasts before. It's central banks, right? I mean, we seized the Russian reserves in 2014. Every central bank that has a large allocation to treasury started to feel nervous, I don't think it's over. I mean, if you look at most of the central bank buying, it's come from, so they the People's Bank of China, but they started from very, very low. Like that was a big anomaly in terms of the Chinese gold reserves. They were like less than 2%. I mean, and you average, I think maybe the Banca d'Italia or the Banque de France, they have like 10-15%. So you could actually this could keep going for quite a bit from the Chinese bid. And obviously there's this geopolitical concern for them where it's like they're not certainly not a value driven player, right? They don't buy gold because they think gold is cheap. I mean, they have like strategic goals. But outside of it, it's been kind of like second-rate players, like Poland, Kazakhstan, Turkey. I don't think we've seen the big guns. Like I've seen this chart of right at the peak, when gold was like 4,300, you could say, oh, it's a higher share of central bank reserves than I think the euro. Like, well, it's all price appreciation. What happened is, long-term bonds have gone down, gold has gone up, but it's not really dollar moving. I think my buddy Brent Johnson from Santiago Capital actually got the number from the World Council, and it's not that much. I mean, the demand from gold has really been, as far as I can tell, it's like Indian moms buying dowries for their daughters, and Chinese, grandparents who are, lost a bunch of money in real estate, feel nervous about stocks because Chinese stocks, they go, they spike up and down, and rates are very low. So it's still kind of been, again, we haven't seen as much central bank buying as you would think, and certainly in the US. I mean, you look at the shares outstanding of GLD or GDX. It's actually, for GDX, I think it's gone down, which is insane. Like, I mean, because you look at the price action of miners. I mean, I don't think we've ever seen such a disconnect, like a sector, like, when we have like booms, like, oh, AI, you see the Cathy Woods, you see the money flow. This is a very rare case of an asset that just completely takes off amidst continued outflows. So I think long term, the picture is still actually quite bullish. Again, that doesn't mean that this correction cannot last. Obviously I wouldn't allocate new money to gold at this point.
Right. Yeah, I mean, to me, the biggest risk with all those things, and this is where gold got a lot of folks back in, like kind of 2008, 9, 10, when equity started to rally. I'm very skeptical that those things are going to fall a lot, just because I don't see that pool of demand going away. I think the bigger question is, can they just kind of sit? Because the problem with compounding returns, right, is that you need to keep doing it. And equities have shown this ability to resiliently do 8-10% a year, lately even higher. And so, personally, my worry for Bitcoin or gold is that they just have a few kind of just flatline years, and then you start to see those compounding returns actually drop pretty significantly, because you add a few zeros in, and that 50% return suddenly becomes 10%, and then 5% and 2%, and then that's when you really worry if people start kind of pulling out, because then they're like, oh, I'm not keeping up with equities. That's always the hard part. So you made some really interesting points about there not actually being that much demand. I'm not sure how into the weeds you get on kind of supply and demand of gold, but I'm curious in terms of kind of the gap. How much do you think this is just steady, kind of permanent acquiring, like annual acquiring of gold, versus there's kind of an immediate shortfall that gold miners need to rush to fill? And is there a sort of time frame that we need to fill it? So I came from my background was on the ag and energy side, and we'd say, okay, there's a gap, there's a shortfall, and it has to come from X investment. We need to add, Y acres,
Right.
or we need to increase, kind of drilling or fracking by, this many acres and barrels. So I'm curious if you see from the gold side, something similar that needs to happen to fill it, or what?
Well, I mean, the big difference between the gold market and other commodities is kind of the stock versus flow argument. I'm gonna mess up the numbers, but I'm gonna go for it anyway. You have to think about like how much inventory do you have versus new supply, right? And typically for the old market, I'm gonna mess it up, but it's probably like 30 days, I think, of inventory, and then we produce and consume about 100 million barrels a day.
Yeah, it's definitely that order of magnitude. It's not a lot. Like,
right,
we can hold like
so,
several months, or we can hold a year's worth, but for energy, yeah, it's typically a month or so.
Gold is the opposite, right? The supply is extremely inelastic, and that's why gold has remained kind of a store value for so long. It's very hard to find, right? It's hidden in the mantle of the earth, and it takes a long time to open a mine and get the permits and all that stuff. So that's a huge difference between the gold market and other markets, is that your new production is 1%. So most of the most of the gold is above ground already, and the question is, I guess, um, do we see? So where you're trying to go with that is, I guess you worry about, okay, so we have, okay, your idea was which I agree with you, that commodities tend to have these spikes up and then they go nowhere for a long time. And as we go nowhere for a long time, people kind of give up on their holdings, and then these kind of the Indian moms that start selling their jewels. And yeah, I mean, it's possible. I mean, obviously anything's possible. I still don't. I mean, I don't think that. Like, if we have the kind of world that I believe in, you know, where things run too hot, and where the biggest risk is inflation and overspending, I think that will create that demand. Like, if I look at, you know, people's portfolios, what are they most overweight? I mean, you know, we had 40 years of falling yields, and, you know, in Europe we had trillions of negative yielding bonds. That's somebody still holding that crap, you know. And then, you know, if you want to take the kind of the equity angle, it's like, well, we have, you know, 40% of the stock market in 7 stocks. These are the things that worry me in terms of over allocation. Now, is it, you know, I still think most people have very little allocation to gold or precious metals. So it could be over time, but yeah, I think I have more.
Well, what I think is interesting is I still think the allocation to gold is small, or was
Right.
last I looked, and crypto is pretty small. I do
Yes.
think gold plus crypto is, if you view them as both kind of, you know, reserves, or, you know, safety against US dollar and bonds. I think the two aggregate is actually fairly large though. And so I think that's the big question is crypto its own segment of the portfolio, or is it competing with gold? I thought what you said about competing with bonds was really interesting though, because, you know, that's a new angle from my perspective, because I think if it's competing with gold, it's hard to see them both doing so well while equities are doing well. But if they're competing with bonds and you can continue to see fight from bonds, I mean, that could be the answer, and that could go on for pretty extended time period, right?
Yeah, I agree. One thing that worries me a little bit with both, well, crypto and lately gold, has been this rising correlation. I mean, certainly with crypto, you see it if you look like a long-term, you know, correlation of crypto versus stocks, or even the 60-40 portfolio. I mean, it used to be negative or zero, and that's the typical pattern. As an asset get adopted, and you see ETFs and IRAs pitching into their boomer clients, you are seeing this correlation start to rise, and I think that was also a tell sign for gold. Gold started to do the same thing as well, in that run up, and that, I think that's when it told me that we got to that, you know, stupid, like that last pop, like when we just rushed through 4,000. That was really like, I mean, crypto, you kind of expect that to be a little bit, you know, Nasdaq on leverage, right? Just because of the players. But you see gold acting like Nasdaq on leverage, I mean, wow, we have a problem. So in a way, I mean, I kind of welcome this, you know, this breather. You know, you had again, you know, healthy bull markets are, you know, don't go up by 3-5% every day. At some point you need to shake the weekends, and I suspect that that's what we're doing. We had a lot of both in gold and crypto, people who should not necessarily be there, who didn't have the strongest hand, too much leverage, so we're washing it out. And again, that doesn't mean that the long-term case for it is still um is negative. On the other hand, that makes it stronger. And yeah, I think the competition ultimately is with bonds, not equities. Equities will do what they're gonna do. It's not. I'm not on the kind of secular bear market, you know, view of equities. I think we still the biggest problem, if you look at your menu of assets, is on the treasury side, is on the government bond side. This is where the supply is overwhelming. This is where we have all these fiscal issues. This is where we have, central banks independence being, that's the trouble side in the portfolio.
Yeah, I agree with you. I mean, and the correlations thing. So, the fund that I run is a risk parity style of fund, and those have historically, the whole bet is on these sort of negative or lower correlations. And so, it's a little scary as a fund manager right now. Where can you go if everything's correlated? It also makes me worry if we ever do get a pullback, that if everything pulls back together, what's that going to say for people with leverage in the system, right? Are they gonna have to start liquidating gold to finance their, their equity calls and, margin calls and all that stuff? It's hard to say, but it is definitely scary as a fund manager. It's getting harder and harder to protect against tail risks, because it seems like each time something that seems intriguing, goes to the moon, and it's like, all right, where's the next one? So I loved the energy stock call because, you made a great point that so much of this capital of the macro portfolio is tied up in really just a few stocks, and those are not energy stocks, and energy stocks have been very much out of favor, with this kind of decarbonization, reducing carbon footprint. There's always been this question of, there's a lot of cash getting thrown out of these energy companies, but for how much longer? And how do you balance that? Now I think the pendulum's starting to swing, right? Because with Trump and a lot of pushback against kind of climate change, I saw Bill Gates came out yesterday and said something, or the last couple of weeks, he came out and said, well, we're going to have to live with climate change now, and we're going to have to figure out, how to mitigate it and kind of what's the balance. So I think I'm not going to say things are swinging the opposite way, but they're certainly moderating to where people are trying to figure out how much oil is going to be in the stack, how much coal is going to be in the stack, as opposed to we're going to zero. So I'm curious, how you would balance, those different things and what you see from a global macro view, particularly because when you speak globally, it's so fascinating. People talk about, well, China adding more electric, power than the US, and they're also adding more coal than the entire rest of the world, right, and more natural gas. So it's like, they need so much stuff, and that gets lost in the mix sometimes.
Yeah, these are all great points. I mean, the case I was making initially for energy was really just a risk management standpoint. It's like, if I look at the picture of what could go wrong in 2026 and how we can hedge that was my point. But I do have some fundamental view, and yeah, I would I found the point you made about energy is interesting, clean energy and the transition to renewable. I was actually looking at in the context of AI, right? So you hear all these data center built up, and of course it's massive demand for energy. And I was wondering, how does the EIA is the International Energy Agency, and they produce kind of supply and demand model of global energy demand. I was wondering, how do they, how do they factor that? And then they've actually done quite a good job in terms of modeling it. Now they forecast that data centers are going to consume, I think it's between India and the UK in terms of consumption. So probably like you add a G7 economy just for data centers, and that's twice as much as they expected 2 years ago. So my point is that it can go up, and I'm like, okay, well, how do we reconcile? Because you look at the EIA forecast in general, they have this view that the oil market is in surplus. Well, it's because they think, if you look at the projection, they think that more than half of the extra demand for energy is going to come from renewable sources. And I would be very skeptical of that, because we've seen these forecasts again and again, and you look at the share of renewable in the global energy mix. I mean, we've thrown trillions of dollars at the problem, and we still are pretty much the same energy mix. Now you could say for AI, you see these deals where it's trying to go nuclear, but again, it takes many years to build. these facilities. So it could be that maybe the EIA is right by 2030, but we need to get to 2030. So yeah, I would see that as a potential kind of underappreciated risk. And it's not just the consumption from these data centers themselves. It's also the building of them. Like, it's huge. It takes a lot of energy to build stuff. And these are, I think people kind of work off a model that's based off kind of industrial facilities, where actually data centers are quite different. They have a lot more cooling needs. They have a lot more walls, which means the building is less energy efficient. So if you just do a square meter, it's like, oh, well, you compare to like other kind of CapEx surge and you kind of estimate this is how much energy is. It's actually going to be a lot higher, just because the building itself, the construction of the building requires more energy. And then the last thought that I wanted to share on this is kind of a long-term thought on relative prices. My impression of the 2010s is that the biggest, one of the big revolution was we found ways to produce energy more cheaply. Right? That was fracking, horizontal drilling. We came from this, $150, $100 oil prices, and then 2014, 2015, it collapses to basically more than halving of energy prices. Now, what did that do? Anything that lowered the relative price of energy and then increased the relative price of everything else, right? So if you look at energy as a share of S&P market cap, it just collapsed because you could use that cheap energy to make more things with that. I'm wondering if we're not doing the exact opposite thing in the 2020s. Like, will AI make everything else cheaper, right? It's cheaper to go see a doctor. It's cheaper to handle a customer request. It's cheaper to make a movie. So one thing, though, that you cannot ask ChatGPT to drill an oil well for you. Like, that's the one sector where I could see very little impact. Also because it's a highly capital intensive sector. Like, there's not a lot of labor that you can automate. So my idea is, 2010s, the price of energy relative to everything else falls. 2020s, the price of everything else, if AI is true, will fall. The only, relatively speaking, that means that energy becomes more valuable. So again, that would be a case for having an overweight energy going in 2026.
Yeah, I agree with all that. I mean, I think you made so many great points there. And I do think that was the single biggest shock. And the whole green story is struggling with, to your point about the energy mix not changing, that's not actually, I would say that renewable production has actually massively surprised to the upside, I think. Yep. But the problem was overall energy demand, to your point, grew just as fast or faster. And so that's why it wasn't able to change the stack or the mix. And that's, to me, the really fascinating part. And that's the fundamental economics conundrum, right? Like, the more green, the more renewable energy that you bring online, the more you increase supply, cheaper energy is going to find new homes for demand. And this time it was crypto and AI. Maybe it will continue to be those data centers. Maybe it's going to be something else, but it's going to, maybe it's going to be now to help mine more gold, because obviously energy helps get gold out of the ground too, right? So, I think all those things are fascinating. So I love it. I do have one big question though for me, and this is what I wonder, and this isn't specific to energy, but since you brought up energy, I'll kind of pick on it. I wonder now, with this market cap weighting stuff that we've been talking about and all this demand chasing just a few stocks, let's say you're right about energy stocks really, seeing a big boost in profitability. But what is the catalyst? Can they go to high valuations? Because if people just fundamentally, when they buy more stocks, that money is getting plowed into the biggest market cap names, and they've lost a lot of market cap share. How does a stock regain? And so this is really a bigger question, because if you go back now about 15 years, all these sort of Fama French, quantitative equity shops, all the fundamental based shops have been saying, okay, all these stocks are cheap. And guess what? They're still cheap. On a relative basis, they're even cheaper, and they just keep getting cheaper on a relative basis. So what does it take to get, to really get a bid under a sector? Or should we be looking at just straight up oil futures as opposed to the oil producers? Like, or do you see an actual catalyst that can get those to rip?
Yeah, I think you brought part of the answer. I kind of like the commodity side because the commodity has to be consumed, right? I mean, when we trade stocks, I mean, we're trading ideas, and you can these anomalies can persist for a very long time. Well, or you have to burn it. So that would be part of the answer. The second answer, I think buybacks are a big part of the story. If you really do have any. It's possible. Like like the market. I mean, it's funny. Energy investors have been so beaten down. They say we'll never be loved again. People will never give us any money whatsoever. But then if that's the case, then and we do have these, and you see that to some extent the gold mining space. I mean, like I said, the flow hasn't come, but yeah, I mean, $4,000 gold versus break even price of
like 1,600 or something.
Yeah, like it's like, I mean, you can buy these companies is going to buy themselves up. So that's one way. Obviously they could buy each other up. We see that in the gold mining space. So there are still ways I think for capital to for markets to work. Like maybe we broke the retail channel, like the passive sector is just gonna, and I don't think it's going to change like more, and nor should it necessarily change. Like I in some way the index fund I think has saved a lot of people a lot of money, and it's compounded wealth, and it's but it doesn't mean that the mechanism of capitalism overall are broken.
Yeah, that makes great sense. And I mean, I think the buybacks is a great point. That would be hopefully what you're looking for, if they're really profitable, right?
Or and you see that, by the way, on the other side too. I think that's you see on the AI Max 7 type. They used to be, so basically their model was they would the Google, the Meta, they would have this big buyback program, but then they, obviously stock-based compensation is a huge thing, right? About a third of their, actually more than that if you go to higher level at Google, like people make probably like 2/3 of their comp on stocks, and but it used to be like the balance was more or less, the buyback covered the SBC basically. And one thing that I find interesting is lately on the type of deal that we see, equity financing, we see debt financing. So maybe that because you need for the system to work, so the passive flow is going to come, and the Vanguard target date fund is going to buy X shares of Google, Meta, and the Max 7, right? But the temptation is all to issue a bit more than that, and I worry that with this kind of capex boom, and you certainly see them getting more and more creative with the financing. Some of them being circular, some of them being debt. It's like, okay, at one point, I think that's one way this whole kind of bubble will burst, is when we'll see. It's not going to be based on valuation. It's just going to be based on supply and demand. We're going to see more shares being sold than are being bought by index funds. And so basically what I'm describing is the exact opposite picture of the energy and gold mining sector, where you have a sector that's kind of eating itself up versus another one that's structurally expanding the float.
Yeah, that's a great point. That makes a ton of sense about expanding the float. In terms of the eating itself up, how do you think they will be able to balance both gold and energy producers? How do you think they're going to be able to balance the capex, pouring that cash into expansion versus buying themselves up? Like, do you think they'll stay really disciplined and focus on buybacks, or are they going to try to double production capacity? Because that's always what we run into in the past with commodities, right? I mean, energy's been way more disciplined over the last 10 years because investors have just said no. But again, a lot of that was because of the green story. They didn't see, they saw this wall in the future. And so they were basically saying like, no, you got to pay it out in dividends. You got to buy shares back. But are they going to start to change that? Are they going to start to realize the same thing you and I are looking at and say, the energy mix isn't changing. Maybe you do need to go ahead and dial up production. Do you think that changes? And how do we, and like, what are you watching for any bellwethers on, again, both gold and energy?
Yeah, I mean, it's always a risk. At the end of the day, it's, you know, management always has this tendency, right? It's human. You want a bigger company, you want to acquire your rival. So it's always a risk. Now the question is it? I would argue, where is the risk the bigger, right? Where is the kind of ego-driven megalomaniac CEO going to, you know, spend a couple $100 billion something with a very low return on capital? Is it? I mean, come on, it's in tech, you know, like you
is
know
it low economic capital right now, though? I mean, when you look, if gold is 4,000 versus 1,500 break even, like that seems like pretty good investment. Is pretty good ROI for increasing capacity.
That's
right?
my point. Yeah, first just in gold, yeah, you opening mines and all that, like it would actually be positive for you know, I mean, break evens would have to go up a lot to invest that marginal dollar. It's still earning a above cost of capital return. So that's certainly in gold. It's not a factor. And then in the energy, you were absolutely right. I mean, yeah, it's been a, you know, that's the story of the 2010s, right? It's all these, you know, shale boom and over investing but again, it left so many scars, you know, and again, I think where are the investors going to impose the discipline? Is it going to be in tech? I mean, you know, Elon can just pretty much walk into a board and I'm going to build Teslas on Mars, you know. Here's the check. What do I sign?
Yeah, where do I sign?
So again, to me, it's always relative. Like, where's it's a human trait, but I think that risk is still much greater. The risk of overspending is always is everywhere, but it's greater in tech. And again, if we think about these big investment cycles, they always end up in TSE. I mean, this is if we're talking about quant factors, right? I mean, so you have the people talk about the positive quant factors, like the things like momentum and value, and you know what, once the most clearest quant factors is a negative one. It's capex. It's sectors and companies that rapidly grow capex underperform. I mean, you've seen that across industries, across time. So again, that I think energy is off the hook here.
That's really interesting, you know, and I actually have not heard capex kind of talked of as one of the key factors and that negative factor.
Well, because it's negative, right? So I mean, the incentive on you know, an academic is you want to find an anomaly that works because you want to launch a fund that, you know, harvests that anomaly. But yeah,
I mean, at least and it's harder for the retail investor, obviously, but that's part of when options come into play, right? So that's one of the things we talk about is harder to get short, but, you know, certainly if you're looking at put options and if you have a diversified strategy, I think that's a great point, kind of tying this back to MenthorQ's kind of user base. If you're selling these 0 DTE puts, like, where do you want to be long some tails? And I think you make a great point. That would be the ones to own it where the capex is high. Do you see capex expenditure? So we discussed that in gold, it could be a positive. In energy, it hasn't happened yet, but could start to like, that'll be the big question, is what they do if we get the energy price rally in 2026.
But yeah, again, this would be a good problem to have, right? I mean, for this, you know, scenario to play out, you need I mean, for now, we've had this kind of low energy. You've seen, you know, drop. You've seen U.S. production kind of roll over. So I think you need a couple of years of, and also you need a much steeper curve, so that, you know, because what matters is kind of the long, you know, if you want to hedge new production. So I think we're still very far from having this conversation.
Yeah. So then, granted that we are, so then how do you decide between the underlying versus the stock, right? Like energy, because I noticed for gold, you were saying you like gold. I mean, again, I realize there's a pretty high correlation, whereas energy, you kind of gravitated towards the stocks. What about buying crude futures, right? Or gold miners? Like, how are you kind of thinking about that decision right now?
So for gold, I think I would probably go. I mean, okay, historically the miners have been crap, right? Historically, it's unfortunate. It's quite common across the resource complex that you're giving your money to cowboys that if they have $1 in their pocket, they'll spend two, and they're terrible allocators of capital. And that being said, yeah, listen, gold is going to do what it's going to do. It's super speculative at this point. It who knows? Maybe it consolidates here and gets back on the uptrend. Maybe it could. But I do know that the miners are going to make a killing either way, right? You mentioned break even at 1,500. So there's so much room. So I would probably go with the miners with the caveat that the beta is probably more than one. Depending on which names it is. Maybe if you go with the kind of better quality, larger miners, you get a beta of 0.6, 0.7. So energy, yeah, maybe it's the commodity itself. Maybe it's again going back to my idea that the biggest risk for 2026 is that yeah, we see oil price spike again, and that makes suddenly the Fed completely unable to hold its two-ish view. Then it's probably going to be yeah, it'd be in the physical commodity.
Nice. I think you're on mute, Ryan. Sorry.
Yep. Oops. I think that's always the question for me. Background as a commodity trader, and as we move into the macro, is where do you want to place your bets, and they behave pretty differently. So I guess we talked about a few different really interesting kind of macro leaders and potential laggards. In terms of building your macro strategy, do you tend to jump around? What drives your focus from a fundamental standpoint? Like how much is kind of central bank and that stuff versus valuations of the individual asset classes? I mean, I realize to a degree you have to use all those, but if you're a retail investor trying to think about how do I keep forming a view and then updating a view, so if the stuff we talked about today is coming to fruition, if you kind of built a simple checklist of like what are the 3 to 5 things I should be looking for that tell me that this is happening, or that the world is changing, my outlook needs to change, what would be at top of mind on your radar?
So primarily my audience for StoneX is institutional and specifically pension funds, and these are probably the slowest investors out there, and in a way it's their advantage, right? It's if you can plan for 15 20 years, you can earn some premiums that are not available for people who have more. So that's what I focus on. My impression on general kind of asset allocation questions is it's kind of like playing tennis against really bad players. Is you win by not losing, and so that's why I stayed silent on that gold versus Bitcoin question, because I'm like I'm not really sure we can pick winners, but maybe the way you make money is by avoiding losers. One study I was making, so I guess you mentioned risk parity, this permanent portfolio idea, right? The idea that you kind of want to break your portfolio in 4 quadrants, and so I'm just going to walk through one is stocks. Basically, stocks do well when the economy does well, so it's kind of a bit of growth. One is long-term treasuries, and then that usually it's your hedge against recessions. The third one is going to be your kind of commodities. Gold goes in there. That's a hedge against inflation, and then the bottom one would be cash, which does well when nothing else does. And historically, that portfolio has been extraordinarily steady. Like barely a down year. Nothing stunning, but I mean, you can probably increase that with leverage. But that, if I look at that, I'm like, okay, maybe I'm not going to pick the winner. Like I can see a case where, stocks are massively overvalued and they correct a lot. I can also see a case where stocks keep doing very well. So I'm saying between one thing though is like I've noticed it's maybe a lot easier to identify the thing that's not going to do well than the thing that's going to do well, and that's been really my main message for the past 4 or 5 years, is that these kind of long-term treasuries are broken. And I don't think it's going away. And you ask me like what trigger would I see for this to break? I mean, you need to see what we saw in the late 70s. You need to see very high inflation. You need to see a revolt of the population. You need to see central banks becoming more independent. You need to see politics moving back to the center. You need to see geopolitical tensions cool down. So my idea is that we're very, very far from it. So, yeah, I think the biggest risk again is that these trends of the past 5 years accelerate, not that we revert to the mean. And that's something to keep in mind, because I feel a lot of the finance and any sort of models wants to bring you back to the mean, right? It's just the nature of modeling, because it looks at the data. It's like, oh, we're too high, we're gonna go down. It's like, no, but there are trends that are, that actually in physics you have what brings you to the center and what brings you out. I think and then the faster you go, the stronger we are still in the thing is spinning faster and faster.
Nice.
That's fascinating. I could go on talking about this all day. I mean, I completely agree with you. I mean, we dropped from our fund, the one bucket we've sort of dropped is treasuries. It's not to say we don't touch the space, but yeah, I couldn't agree with you more. Fabio, did you want to hit on anything else before we?
No, I think this was awesome. I think we have a couple of minutes left, just to respect your time, Vincent. I think it was a very awesome session. We touched a lot of things, so I really appreciate your comment, you being here, and we hope to have you back again soon, sometimes if you're interested. And it's awesome. Thank you so much, and thank you, Ryan, as always.
Yeah, thanks.
I enjoyed
the
conversation. It was a pleasure. Thanks,
Thank
guys.
you, guys.
Have a good one.
Bye.